Hi guys, welcome again to this this week's stream. I just had some technical issues, I had to shut it down and start again. But yes, we have these sessions every week for those that are just joining, and basically we talk about news around the world. My name is Ola, and I'm a financial educator. And you are welcome if you're just listening. Please subscribe, hit the notification button. What else? Sign up to our free newsletter and keep learning. So we're just focusing on one news today because it affects all the economies around the world, and it's important for you to understand what it is. Basically, the U.S. Feds have announced their first of a series of rate cuts to come right now. First thing you are going to establish is what is that rate? What does it mean? Like, what is a rate cut? What does that mean to me? And then what does it now mean to each economy? We're going to break it down for the impact on each economy and asset classes and everything in between. The first thing is, what is the rate that they are talking about? So understand this: the interest rates that you see or that you get when you walk into the bank, or when you borrow or when you invest, it is driven by guidance from the central bank of that economy, right? Such that when the central bank takes up the rate, all the interest rates go up, both borrowing and interest on return investments, right, go up. Is standard. So when the Feds, so what we have seen so far before now, and I mean, we all hear from the pandemic, right? Post pandemic, the response of almost all central banks around the world was to take up interest rates. Why? Because inflation was a problem. Prices were rising too fast, right? And so they needed to slow it down. Now, why? What's the relationship between interest rates, taking up interest rates, and inflation? Fundamentally, inflation is driven by either cost of production is high due to other factors, supply chain disruptions, blah, blah, blah. And the second thing is that what's it called? There's too much money supply in the system, right? Now, what is money supply? People have too much cash chasing few goods, right? So the central bank generally tends to use interest rates to slow down that too much demand chasing supply. How do they do that? Generally, just know that the world is funded by debt. So people borrow to buy houses, people borrow to buy shares, people borrow to buy bonds, people borrow to invest generally, people borrow to spend on goods, their credit cards, right? Now, when the rate to borrow is too high, you begin to rethink it, right? You begin to slow down. You need to make those adjustments. You ask yourself, do I really need this? So you see a slowdown in the demand for property, you see a slowdown in demand for stocks, right? So they generally just slow things down by taking up interest rates. The idea is that they will keep those things slow until they see inflation gets to a good level. Now, what has happened over this period is that we've seen inflation get as high as 7, 8, 9 in some developed economies, and then we've seen inflation begin to taper down. Now, in response to that tapering, we saw that the Bank of Canada cut rates 2 weeks ago. The Bank of the European Central Bank cut rates last week. Now we see that the Feds, US Feds have followed suit. What are they saying? That these numbers are getting to where they want it to be. And so they think they can now begin to push the economy up again. Remember or understand that when you make cash available, the economy begins to move, people begin to produce things, blah, 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 and the economy just picks up again. So basically, what are we saying? The Feds have cut rates. And then because America is the country of the world, yeah, just know that and no peace. What we are going to see over time is what we're going to discuss here. The fact is that yes, the ECB, that's the European Central Bank, has cut rates. The Bank of Canada has cut rates too. However, the fact that US has cut rates is more significant and impactful to everybody in the world. Why? Because most major currencies of the world trade against the dollar. So whatever happens to the dollar affects everybody. Just know that and no peace. And so when we saw the taking up of interest rates, we saw a reversal. So you would remember there was a time when it was in news that the pound was 1 to 1 to the dollar. The pound is usually maybe like 1.3, 1.4, 1.2 to the dollar was 1 to 1, right? Because the dollar really appreciated, right? You would have heard all the currencies of the world devalued against the dollar because when the US Fed started taking up interest rates, there was a reversal of cash. So everybody was selling whatever the US investors who had borrowed locally to invest outside of the country sold those investments, sold that currency, and converted back to dollar to go back to their country, flight to safety. That was what happened. So now that the Feds have cut interest rates, the question is what impact will it have? Now I'm going to start with the US. I'm now going to go to Africa and then go to Nigeria. Now for US, so if you are just joining us, say hi. I can see some people are online. Please say hi. I'd like to say hi to you. I'd like to recognize you and all. But yeah, we continue. So if you are so for the US economy, what is going to happen? It is just starting, right? But what we will see is that as interest rates begin to come down, first of all, to highlight the fact that the expectation was for him to reduce the rates by 0.25%, but the rates were cut by zero point 0.5, which is double the expectation. So the markets were actually not expecting as much of a rate cut. And they are saying that there will be two more rate cuts this year. And this year we're already in September. September is already over technically, right? So expect that there'll be like a 1% cut in rates before the end of the year based on their guidance. Now, what's going to happen? The first thing is that it's going to be cheaper to borrow. And the moment it gets cheaper and cheaper to borrow, what happens? More people begin to borrow. And what do they borrow to do? They either borrow to consume, credit cards, blah, 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 or they borrow to invest, mortgages, margin facilities for stocks, just borrow. So what's going to happen is that all those assets that people have been funding previously with debt, there's going to be higher demand for them. And so prices are going to go up. So asset prices are going to go up. That's what's going to happen. And we'll begin to see it now. Understand that the way the markets work, especially active markets, stock market, the bonds market, those markets are very active. So if a stock price is currently at $100, it might go to 120 and then come back to 115, but it might not go down. It will not go down to 100 again. That cheese has moved. That's literally the way it is. So if you were anchoring and saying, oh, this particular stock is at 100, let me wait for it to come back down, it may not, because there's a fundamental change to the workings of the economy that may not support that, except if some major negative news happens. So asset prices are going to go up generally. That's in the US. It's given. Now, the first thing is that the direct asset, the logical assets, blah, 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 going to, then what happens over time as they keep cutting rates, which they say they will, you'll find that more capital will begin to flow into venture capital, meaning buying companies, and then that's where it gets interesting globally. So we explained the asset prices are going to go up, but also understand that the Feds are also going to be watching the inflation numbers, because if we overdo it on the spending speed P and inflation goes back up, then there might be a slowdown in the speed of the rate cuts, right? But we don't expect that they would cut rates and then take it back up, and then no, they don't do that. They will just stabilize, leave it there for a bit, and try and tweak other things, other tools to produce better outcomes, if that's clear. Now, moving on to Africa. Now, Africa should benefit from this, because one of the reasons why almost every, in fact, not almost every African country's currency has devalued against the dollar, apart from their internal issues, is just this reversal inflow, right? The fact that everybody was going back to the US, all the US investors were reversing the flow, all the borrowing to lend, borrowing to invest, blah blah blah, all that stopped, right? So when there's a reversal, it's going to flow everywhere in the world, not just Nigeria, not just Africa, not just US. It's going to flow everywhere in the world eventually. So they'll first of all buy up all their assets to a point where it doesn't make sense, and then now start to, okay, where else can we go, right? So Africa should benefit, and I'm using the word should because there are other things that will make each country benefit from it. Also, because Africa is a continent and not a country, right? Now, the fundamental rules still remain the same. For people to bring their money to your country to put into anything, you must be selling what they want to buy. So the question is, which countries will benefit more than others? It's the country that is well positioned. Do you have assets that people want to invest in? Have you created products? Have you created investment vehicles? Do you have businesses that are viable and have potential to go global? Do you have infrastructure products that are bankable? Or infrastructure deals or projects, not products, projects that are bankable. So now, if you want to know the countries that will most likely benefit more than others, right? Consider their infrastructure positioning, consider their development, their business development. When I say business development, like their venture capital ecosystem and how developed or not it is, right? And consider their political positioning, right? If you're aligned, if you're misaligned with the developed south, developed north, then you might not get any of this flow, because if there are restrictions in flow of capital from the US to your country, you won't benefit from it. So Africa as a whole should benefit from it. What does that mean in terms of benefiting from it? It means that your currency would strengthen on the back of this news, right? But there's a caveat here. You must be selling something that people want to buy, and you must be positioned for them to be able to access you. If your country in Africa is not, then it's as good as nothing happened. You will just, in fact, you won't even see the money be flying past you in front, behind, and you will not get access to it. You won't be able to plug into that flow. So positioning does matter. And so when you see things like presidents signing deals, mutual agreements, bilateral agreements, trade agreements, all those things, those are the things that plug countries into the flow of that currency, right? Another thing also is if you have euro bonds that people can invest in, or if you're issuing euro bonds, people need a vehicle to plug into. So if you are not positioned, forget about it, right? But there are some countries, for example, that open up the new stock. I think Ethiopia, for example, is just starting up their stock exchange, right? This might be a good time if they have other things, because I think Ethiopia as a country is trying to open up, right? Now all those things, they help, and they would help their currency. And once it helps their currency, let me explain, in like break it down. If your asset, if for example, the asset that you are selling to the world is your stocks, like your stock market, right? What will happen is that for an investor in the US or in the UK who has access to cheap dollar, to access you, to access your stock market, they will have dollar first, but they'll have to sell the dollar to buy your currency. And then when they have your currency, they can buy your stocks. What that means, that there'll be additional supply of dollar to the country. And that's what stabilizes the economy. That's what stabilizes the exchange rate. That's what stabilizes inflation. That's how those things happen, right? So the countries that are positioned for that plug in are the ones that will benefit from it. But guess what? Cash is coming to everyone. This is a big deal. It actually is a big deal. That the Feds have cut rate is actually a big deal for everybody. And it signals a change in the economic cycle. Yeah. Let me not go into that in detail, but yes, it does. And then finally, to Nigeria. Okay, so to summarize for Africa, look out for the countries that have good contracts, that have good bilateral external relations. They will most likely benefit from this interest rate cut more than others, right? But generally, we expect that the currency devaluations generally, not specific to it, any country, should stabilize on the back of this news. And then finally, Nigeria, what is the impact? What should be the impact of this, right? So for Nigeria, what we have found currently is that the Central Bank of Nigeria has been taking rates up, right? The same logic as why the Feds were taking rates up, but our issues are more intricate in Nigeria, right? So what we have seen is that interest rates, for example, the rate on the bond is like 20%. Now, so you understand why that is attractive, why the central bank will do that. The fact is that the guy in the US who will now, in subsequent months to a year or two, will now be investing his dollar at 3-4%, will look at your 20 and say, if I can convert this my dollar at 1,006, right? And I can get this 20%. And you can tell me that I can convert this dollar back, this naira that I sold in a year's time after collecting 20%. I can sell it, the bond, and then make back and sell and buy back my dollar at 1.6. I have made 20% return. So why won't I do that compared to this 4 that I'm getting? That is how those things happen. And over time, you begin to see a flow of dollars. So they'll first come, test, go in, go out, and after a while, when once everything goes smoothly, they begin to come in numbers. That is how it happens. However, like I said, it's not just economics that people consider. There are political factors, there's socio-economic factors to an extent, because even if you are burning yourself down in a country, as long as your financial market is still awake and alive, it's not their problem. And know that and know peace, right? Such that when you are attracting investors, you also try to attract the people that will do infrastructure, right? Which are longer term projects, right? So that's why I talked about the fact that your infrastructure project, the positioning of assets that people want to put money in, also matters in that process. So, but what am I saying generally? That this is actually good news and a little bit of respite for all the financial pressure that we have seen in Africa, even around the world, right? However, there's a risk that inflation will be triggered by this because when money is cheap, prices will go up, right? Especially in countries where that has suffered significant devaluation, prices are already up, and then when you now make money cheap, it just pushes it over more, right? So what am I saying? This is going to affect your investments. If you haven't been investing, right, across the world, right, which is something that we help people to do in the Money with Club, if you haven't been investing, then it's not too late to start. In fact, there's never a too late period, right? There are always assets that would work for different type seasons in the economic cycle, right? So I encourage you. The global economy, everyone around the world has experienced significant inflation and loss of value in just leaving cash idle. And it's not about Nigeria alone, it's not about Africa alone, it's a global situation, such that it is very, very important to invest. And so if you don't know how to invest, you don't know where to start from, then please just connect with us and we help people put their finances in order, and that's the truth. This whole economic thing has been very, very dramatic, very shocking, very everything for people, but it's just economic cycle. I've seen this movie before, right? And so if you work with people that have seen this movie before, they sort of know kind of what to expect. Of course, nobody has like a crystal ball, but they just have a general idea of this is how these things work and this is what you should be doing per time, right? And it might sound funny, but what can happen is that a year down the line, like, oh, they told me that it wasn't too late. I thought it was too late at that time, but they told me it wasn't too late. If I had, I would have. All those if I had, it doesn't convert to money, right? But anyways, thank you so much for listening. I see people, but y'all didn't say hi. Please say hi. Let's know who's listening in. Um, and then see you next week. If you do have any questions around this, any specific questions, always feel free to type it up in the what's it called, the comments, right? And be sure to respond to it. And if you found it valuable, also let us know. Let's be encouraged, knowing that people actually benefit from what we're doing. And don't forget to connect with us on our social media handles and share with a friend.